Hello, everyone. Thanks so much for being here at the Emergence 2021, the global marquee conference that connects innovators, founders, investors worldwide. My name is Jessica Wang. I'm the CMO and partner at INP Capital, a Canada-based VC firm and a proud partner of Wholesale investor for this conference. So I see today we have quite some distinguished guests, a lot of old friends. So why don't we, start by doing a quick introduction of yourself. But in addition to that, maybe share with us what you see in your neck of woods now, the overall investment VC startup landscape. I'll start with maybe just the order on my screen from Erik.
Yes, happy to be here. So Erik Bullen, I'm an angel investor at Launchpad Venture Group. We're about 150 members based in Boston. And we invest in seed stage companies. With the pandemic hitting last year, I think what a lot of us saw was that the first 2 months, there was a full stop, right? It was, no one knew what was happening. I think capital flow stopped. Our portfolio companies looked at their current business. Some laid off, some looked at new deals and tried to retain the customers. But eventually, as the summer progressed and we got a handle of things, I think things got back to somewhat, I would say, not normal, but at the same time, we continued looking at companies and we continued investing. And I think we saw that the known sectors, right, including travel, hospitality, some sports and so on, there were definitely challenges there. But there were other sectors such as future of work, e-commerce, healthcare, wellness, and so on that really attracted additional capital and that really tied into the whole trend of the future of what we would see in the current pandemic and then post-pandemic as well. So fast forward to today, I think overall the startup environment is healthy and we see a lot of opportunity in 2021.
Great. How about Melissa?
Hi, thanks for having me and thank you so much for moderating. I am based in Boston as well. I'm Melissa Withers. I'm the managing partner of RevUpCapital. I have I think an interesting view on the roundtable today in that I started my career as an equity investor and have about 90 companies in a seed stage portfolio. But RevUpCapital is a revenue-based fund and is one of the early funds into the space of using equity alternatives to support early stage companies. But in addition to that, I'm mentor in residence for Techstars Boston and then work with our companies for later stage funding at the Series A level. I think there's tons of money in the market right now in North America, and there tons of it. I mean, it's sloshing around so much so that sometimes it makes me nervous when the tsunami of money gets that big because weird things happen. When I think about looking at the data from the last couple of months, there have been a lot of deals made, but there's been a precipitous fall off in investments in women and others who have been disproportionately affected by COVID, by being called back to domestic duty and having other things that have become barriers to their entrepreneurial journey. So I'm really interested in that dynamic and mostly interested, and I think in this moment, looking globally, incredible amount of disruption in the capital markets and a lot of room for innovation. So hoping we'll talk about some of those trends today.
Oh yeah, for sure. Okay, your turn, Ken.
Yes. Thank you very much for having me here today. Ken Goodwin, the managing partner, Genesis Capital Markets, based here in New York City. We are a boutique firm, but we have anywhere between 50 to 75 different types of firms that we invest in. We're at Series A. Typically for us, we've done a lot of our investments mainly in digital transformation. So what we have seen with COVID-19 is a spur of digital transformation, mainly in fintech technology, red technology, edutechnology, health tech, medical technology. We've done some work in smart cities, and smart cities for us has really been driven by big data. So what we see that's going to happen in the future is that cities are starting to use data as a way to develop their cities, their infrastructure. Case in point, one of our investments is a bike firm that's actually using that particular mode of transportation, but also providing the data to help the city to build the roads and bridges and so forth. So we see an avenue of what they call future state of work and future state of living. And future state of living for our firm means to how do you manage food, and that's food sustainability. So that's also track and tracing mechanism. We're one of the few firms that actually invest in blockchain enterprise, which is very significant behind that in terms of using distributed ledger technology. But we also, at the same time, we focus on artificial intelligence, which we tend to look at third wave AI, which is a good way of looking at in terms of doing analytics to determine whether or not firms are actually having new products and services in place. So we see digital transformation as a way going forward in 2021. In terms of the actual deal flows, it's quite interesting. There's a lot of money out in the marketplace. What we have seen was pre-COVID-19, you have a huge amount of deal flow, then it stopped for a period of time. What we're starting to see now is we're starting to see a lot of flow of funds going to old deals. The new deals will probably come out maybe from June to probably August and September. So we do see a lot of new deal in the pipeline, which is very good for us because those are the things that we want to invest in going forward.
Oh, wow, that's interesting. I'm sure, what we're going to be going back to that in terms of, the themes for the future, right, of investing. So your turn, Rashmi.
Hi, thanks for having me. I'm Rashmi Pendse. I work at Citi on the Citi Impact Fund, which we launched last year. And we're investing in double bottom line companies in a few sectors: workforce development, sustainability, financial capability, infrastructure, and more recently, we also have a focus on racial equity. So when we're looking at companies that are, going to grow and scale and be financially successful, but also have some sort of social or environmental benefit. And I think in that area, we are just seeing tons of opportunity, to be honest, with everything that's been going on over the last year. So I would echo what some of the others said about, there being a lot of good deal opportunities. I think this last year, there have been a lot of funds being launched to think about investing in certain sectors, whether it's, related to clean tech or whether it's related to the future of work. And then more recently, I think looking at, diversifying the founder base and making sure that, wealth is being created in all parts of the economy. So we have seen, we just launched last year right before COVID and had to adjust to being remote and all of that, but still managed to invest in 11 companies last year. And we have a lot more ambitious plans this year, a very healthy pipeline of companies that we think will do well over the next few years because the problems facing, society are quite large. And these are really innovative approaches to them.
Mm-hmm. Oh, that's great. So, Adrian?
Hey, I'm Adrian Mendoza. I'm the founder and general partner of Mendoza Ventures. We are also Boston-based to join the crew with Erik and Melissa here. We are a fintech-focused fund, primarily on within the fintech ecosystem, everything from digital wallets to blockchain to the capital markets, from fraud detection to everything within up and down, from the front office to the mid office to the back office. Though in Boston-based, we've been part of the fintech ecosystem for the last 5 years, and during this last year with COVID, just like Erik, we saw a little bit stalling out in the market, and then we saw the market skyrocket into the point that a few months ago we were invited to a deal that had a $450 million valuation cap. So there's been this huge excitement especially in our sector in fintech, where things had been a little bit sleepier in insurtech and in fintech. With the entire trend of digitization, a lot of fintech and insurtech and in AI primarily for these sectors and cybersecurity for these sectors as well, has been a huge excitement of dollars pouring into it. Where we had, prior to 2019, there had been a huge sort of slowdown in that space with the necessity of people at home and a lot of the infrastructure being pushed to its limits as far as it can go. There was a great emphasis, and it's perfect for us because it's a space that we know very well. So it's nice to be on that cutting edge of everything that's happening. Even in Silicon Valley, now investors are reaching out to us, excited about what's happening in the fintech space. We're seeing more pipeline than we have dollars even to deploy, which is kind of the inverse of what you would have seen a few years ago. So excited to be here and excited to represent both the East Coast FinTech, and also Mendoza Ventures is a minority and women-owned venture fund.
Wow, that's great. So since we're actually on there, why don't we like open the floor up and tell, because I know everybody had mentioned about certain sectors that they're interested in. So maybe maybe everybody can point like one or two of what you think are the most promising sectors or themes coming out of the pandemic. Adrian, you want to just?
Yeah, I'm happy to jump in. I think InsurTech has been something that just, there had been a wave of rise of RegTech and InsurTech about 2-3 years ago, and it really never moved ahead. Yet in the last 6 months, there's been such of an excitement and such of dollars because the entire infrastructure of insurance, health insurance, auto, life insurance, inherently came to a standstill because it was a paper-based process here in the US. So the digitization, the digital transformation of that entire sector has something that's quickly exploded in just 3 to 6 months, where it had been nascent for a while. So it's really amazing to see this focus. We have a limited partner that is at AWS who had said in 2019, they were reaching out to people for, trying to get people on the cloud. And they were saying, come back in 2023, 2024, when we're ready. In the middle of the pandemic, these same clients who said no, were calling him and saying, we have to be on the cloud. Our employees are at home, our employees are remote. There is no way for them to access on-premise infrastructure. And because of what happened with the pandemic, it's really skyrocketed there. So I think there's really nice to see the dollars being put in to finally sectors that, originally Gartner had said that cloud and on-premise infrastructure in sort of the entire infrastructure market would be finally at like the same inflection point where where spend was at the same point by 2021. Now cloud infrastructure spend has actually surpassed on-premise spend. So what it means for everyone in SaaS, in MarTech, in FinTech and InsurTech, is that now that there's an openness to looking at cloud-based infrastructure, API microservices infrastructure, where there'd been a lot of trepidation about security concerns and, well, it's fine, we can have someone here on premise. I think that's been nice to kind of accelerate what's happening in these sectors.
Can I jump in? So I totally agree with all that. And also on the glass of wine, congratulations to you, friend.
Nice
So we invest industry agnostic, and most of my advisory and mentorship work is industry agnostic. And I think one of the most exciting silver linings to the COVID cloud is around the acceleration of human behavior. So back in 2015, Bill Gross put out one of the best TED Talks looking at why startups fail. And he went through all of the obvious things we like to lean into: team, money raised, and found that statistically across the board, it's timing. And in my own, now having done 135 investments, timing in the market, macro, micro, all the things, timing. And I think what we saw with the pandemic in so many industries was just an acceleration to the finish line on the evolution of some really important both consumer and quasi-consumer behaviors. I mean, so much buying now into middle market is driven by humans who are informed by the decisions they make as consumers, which is why you see so much consumer-oriented marketing now making sense in enterprise sales. And I think one of the most exciting, terrifying, awful outcomes, but also I think really productive outcomes in terms of innovation, is for companies that have innovative business models and are really focused on value creation and really customer-focused organizations that know how to do that. Those customers essentially raced ahead a decade. You see it across, whether it's FinTech, EdTech, conference tech, I don't care, across the industry, is this rapid acceleration of consumer behaviors. And so for those stragglers or laggards who were maybe just still resisting making changes because those human behaviors were so entrenched, the pandemic just unleashed everyone. And we're seeing now across industries, across B2B, B2C, just huge shifts in consumer behavior. Now, the open question is how much of this will settle and become part of an evolutionary shift in behaviors? Where will there be bounce back? Where will there be regressions? Where will there be like a boomerang effect where people went to the edge of a new behavior and then decided they didn't like it and they went back the other way? But overall, I think for so many companies that were waiting for the right time, the time finally came. And I think that's what's driving a lot of enthusiasm in investment and in new co-creation today. Certainly it's driving it for me and many of my colleagues.
I agree with Melissa. Can I jump in? I agree with Melissa wholeheartedly.
Please feel free to jump in, guys.
Yes, feel free to jump in. And I agree with, those are great point of views. I'm going to circle back to InsurTech because one of the things that we saw was the big driver behind big data. At the end of the day, behind all this is driven by the use of data. And so what COVID-19, what it did was it spurred the use of data and how well they can actually use that for automation. So InsurTech, yes, is definitely one of the industries that we've actually saw that was increasing. Actually, we saw that 3 years ago. So when I was in Davos three years ago, we had a private conversation, C3I, which is the blockchain version for a lot of the major companies, such as AIG and the other major companies. And they were talking about using distributed ledger technology as a way to create new insurance products. So those conversations were happening 3 to 4 years ago. It was a timing aspect to it. COVID actually spurred it up because now you have to go back and look at your ecosystem in terms of how you actually use that technology to provide new products and services. So the use of data, how data is being used and stored and captured was really, really, really critical. And so what we saw was a bigger need in supply chain. Supply chain is very broad and is broad-based, but supply chain mainly in medical, and hospitality, but hospital industries, medical industries was very important, supply chains in terms of food. So we saw companies really, really trying to find a way to kind of track and trace from the original source in terms of how food was being developed to the actual consumers themselves in terms of purchasing those foods. So that includes looking at, in terms of what they call specification management, the ability to track information at very low line level, but also at the same time, the ability to use QR codes to figure out what's the consumer's behavior in terms of purchasing products and services. So we saw companies like that were really, really, really gearing towards working with bigger companies in terms of providing those services and applications. So I think that's what we're going to see going forward now in terms of how people are using big data and how people are using that towards different types of supply chains around the globe.
To add to that, both what Melissa and Ken said, so in terms of consumer and enterprise behavior, so look at e-commerce, for example, right? It took 10 years for the e-commerce share of global commerce to go from 8% to about 16%. Within a year, we've jumped to about 25 to 30%, depending on whose data you're taking, right? So it's a huge jump. I think the question is, what's the post-pandemic world going to look like, right? I think most likely it's going to be some kind of hybrid. We'll go back a little bit, but it's not going back down to 16%. We might be ending up somewhere in the mid-20s. So I think consumers have become used to purchasing and shopping online and doing things remote. And the same thing for the enterprise, right? In terms of the future of work, it's kind of a suitcase work. There's a lot of stuff that goes into the future of work. But I think there's a lot of innovation happening in terms of the remote workforce, right? It's not just about communications such as Slack and other communication channels. It's low code, no code. It's how do you deal with HR for remote workers, right? How do you deal with workers that are migrating from, let's say, Silicon Valley to Austin, Nashville, and other places? So there's a lot of activity happening there as well. And I think in the future, it'll be some kind of hybrid, right? I think this, some of the surveys I've seen, if you take surveys of workers, 50% say, I'm just aching to go back to the office. I'm social. I want to go back 50% and say, I'm fine. I'm perfectly happy working from home. And I think the third thing here is, I think just working from home, having a different set of behaviors, being cooped up to a large extent, right? Facing the pandemic, health issues and so on. I think health and mental wellness is a big kind of subsector as well. And there's money going towards that as well at this point in terms of telehealth, mental health, and wellness and so on. There's some specific funds, including one Ventures that's purely set up to invest in health-related mental healthcare type companies. So I think that's an avenue where there's more investment.
Mm-hmm. Actually, while we're on that, Erik, maybe I'm really curious because everybody's talking about this trend and the pandemic sort of being a catalyst. So what's your technique? Like, how do you distinguish a mega trend from something that's only going to be here like temporarily and then they might just change? So capital could rush in but may not be there. Like, how do you tell?
Yeah, I kind of take two perspectives in that, in terms of figuring out whether it's a mega trend or just a fad. Sometimes it's a good guess, educated guess, right? But the question is, how do you educate yourself? I think it's always important to take a look at history and patterns that you see in history, because things tend to repeat themselves, right? In terms of what happens during the pandemic, in terms of bubbles and so on. So I think viewing patterns there, then also looking at overall political, economic, and social type of trends, right? In terms of what's happening here in the country and overseas as well. And then doing some kind of future mapping. So in terms of, let's say, the political and economic situation, I think there's a question of, with this remote workforce, with things being globalized in some ways through technology, is that a trend overall? I think there's a counter push there as well in terms of nationalism, right? In terms of supply chains being federated and let's say the US competing with China and so on. So I think there are opposing forces there as well. I think the other part then is, in terms of looking at specific opportunities, specific companies, the question is, and we saw companies last year in the middle of the pandemic saying, hey, we're pivoting to address pandemic specific issues, right? And our business model is focused on solving those types of things. The question is, are you addressing something that post-pandemic, your business model at that point will fall apart, right? So for instance, a marketplace that is looking at supplying COVID-19 tests, right? Can you take that business model and essentially offer other services beyond the pandemic as well? And as simple as, hey, there are 1,000 different mask vendors these days, right? Is that a business that's going to go out of business post-pandemic, right? I mean, it's simple as that. So I think the question is, have you as a startup set yourself up well short-term and then long-term as well post-pandemic?
Erik, I'm really glad that you brought up business models. It feels a little bit like T-ball, like you couldn't, like, it was exactly what I was thinking and you couldn't have set it up better. I think the half-life of a business model has been shrinking now for decades. I mean, you used to be able to be the CEO of a company for 20 years and run the same business model, right? Longer than that prior. The half-life of a business model is, blink your eyes and you'll miss it. Half-life of a market-facing strategy, blink your eyes and you'll miss it. And I think that has only, we're just living in that moment now. So I think when I think about businesses that have been impacted positively, negative, or are pivoting or reacting to opportunities that the pandemic either created or accelerated, I think what I look for when I peel back the layers is a company that has the capacity to have a dynamic business model. They have a value customer-centric business model where they are enthusiastic and capable of really being in the zone of constantly evaluating and reevaluating how they're creating value, and being very sensitive and okay with the fact that whatever the model today is, that it's not going to last for long. So I've begun to, I think over the years, start to select for founding teams and companies that bring business model innovation into their business as a core capability, but almost in a enthusiastic, like devil may care kind of way, like looking at it less as a burden and more as being freed from the constraints of thinking that they need to develop business models that are going to persist for perpetuity. And I think when you think about how that is in a post-COVID world and all of the changing behaviors in the consumer and non-consumer markets, that I think is what's going to separate those that persist and those that bounce back like in a bad way, poorly from the COVID boost, right? So I think it's this idea about really being viscerally connected to value creation and being close to your customer and just being sensitive and excited about adapting with them. And maybe even in some ways leading them. So I think that's sort of maybe, but I don't think COVID made that. I think I was already thinking about that. I mean, I'm biased because as I come from a business model innovation background, but I think this has only affirmed that for me, and I think made it more exciting for early stage companies to begin thinking about model innovation as one of their core capabilities.
That's a great comment, Melissa, actually. Were you going to say something, man?
Yeah, Melissa, I think you're right, but I think part of it is we saw a lot of people, like especially on the fintech side, everyone from like neobanks to LOSs to like everyone in the supply chain rushing to be like, I'm going to distribute PPP loans. And it's like, that's not a business model. All of that's gone now. So therefore, like, you know, and I think there is the short term and then there is the changing of the revenue and the business model. But I think we saw a lot of it in the market. People changing their entire production to do COVID testing, or people, you know, PE firms that were taking one company and said, you're now trying to work on a vaccine or a rapid test. And I think there's, you know, having been a founder before, there's the importance of having a pivot on a dime, but also knowing, is this a short-term pivot, a midterm, or a long-term pivot? And we saw a lot of businesses fail because, you know what, a year from now, you know, there are going to be vaccines, there are going to be rapid tests. So will those models work and have to repivot again? You know, same thing like the fintechs that were jumping on the PPP bandwagon. We went from PPP to R&D tax credits. So therefore, like, you know, that was really, really, you know, the snapshot of that might have been a little bit too short-lived. But I think for a lot of the founders who are on these types of events, one of the things that they have to realize that as investors, we're not just looking at trends, we're actually looking at all of your competitors. You know, for us, like when we look at something, we're not just looking at one company, we're looking at 5 or 6 at exactly the same time. And then from there, we're getting to see which is the winner in the horse race and which is the team that can pivot, that, you know, will go beyond a trend to also be able to like find, you know, I think there's been a lot of words on the value creation, but also on the clear value proposition to the paying customer. I think it's, you know, it's easier to see it from the consumer. I think it's much harder to see what will those trends be from the B2B customer.
Yeah, I think this is because I'm not unicorn hunting anymore. I'm not looking for the winner take all in the winner take all market, right? So I agree with you. Like there's definitely.
And Melissa, so that you know, like a fund like ours, we're looking for targets for early acquisition. I'm looking for targets by year 5 and 7. You know, there are enough people to play unicorn hunters. I'm looking for targets for early acquisition.
Right, and I'm looking to build companies. So I think that yeah, I think you're absolutely right. And the other downside risk of the opportunity to reinvent yourself is that you reinvent yourself too much and you lose sight of what you're actually good at, and value creation becomes replaced by tactical opportunities, right? And I think that's like one of the saddest things to see, right? It's like when a company takes themselves and puts themselves into a temporary pretzel, only to find out that the value creation there was more of a tactical opportunity and not really like a lasting thing that they could build upon. So I think that's a really good point. And in these moments, if there ever was a temptation or a time to get distracted or to go down the rabbit hole, right? It's happening right now in spades. So I think it's a really good point to make.
I want to add to Melissa. That's a very good point, Melissa. I think it's going back to the why. You know, when we speak to our clients, we go back to our mission statement, the mission, the vision, the values. You got to constantly ask that why. Why are you here? Who you're serving? What's the ultimate purpose of creating a business? So if you stick to the values as to why you created that business in the first place, and you stick to your mission statement, everything else will come to play. You can always, you know, when you pivot, you want to pivot to asking the question, what problem are you solving? And are you solving any problem whatsoever? So you don't want to pivot just to pivot for the sake of pivot. You want to pivot to provide a solution. And then with that solution, it is to be hoped that you're able to provide other products and services. So our ultimate goal is to get back to the fundamentals, get back to why you started your business, and keep asking the question, why? And we tend to, when we have our conversations with our founders, that's one of the key areas that I look at. I like to see if the founders and the team is thinking in that magnitude, because they're not just thinking short term and midterm and long term. They're thinking their ultimate purpose for doing their business. And times are gonna be tough because we want them to go through the business life cycle. We know that there are gonna be times when they're gonna lose money, there's gonna be times they're gonna gain money through revenues. But then at the same time, we want them to understand that you're here because these are the particular values that you have at your firm. And that's actually very important, because at times, as an investor, we're not just providing the capital, we're also providing them guidance and mentorship. So there could be times where they need help with corporate partnerships, and those corporate partnerships gives them the additional revenue cash flow that is needed for the next round. So I always go back to the fundamentals, go back to the why. Something I learned a long time ago in Japan, stick to the core principles as to why you do business, which is to serve your customers, your stakeholders, your investors. And if you stick to the core principles, then you're able to manage your cash flow, you're able to manage your balance sheet, keep things in order. And it's just core values, basically.
Yeah, I'd echo what a lot of folks here said. I mean, for us, we're an impact fund, so we're looking at long-term problems, and how those are not really going to be a fad. The different ways that people think about solving them might change, and so we're definitely looking for experienced founders who can pivot, who know their space well, but who also have a sense of a mission, Ken, like you were saying, who are committed to solving that problem and adapting in whatever way they need to do that. And so, I'll give you a couple examples. I mean, I focus on the future of work. So obviously, ed tech right now is hot. Everyone is stuck at home trying to learn or work online. So in a sense, that's a fad, but that's also going to be a long-term issue. And, I think if you look at higher education in the US, like the university model is definitely starting to suffer. And it's been, an issue over several years, but it's been accelerated recently. The question now is what's going to be effective for people to learn in an alternate way that's more affordable, accessible. And I think there's a lot of different ways that that's happening, but we're also all on video conference all day and probably sick to death of it. So I don't know if the perfect solution exists yet. And we're kind of always trying to look at efficacy and then also access. One thing we're looking at is, are there a group of consumers that have been left out in the past that are now getting access? So what's a great way to have, remote learning for folks who maybe aren't as connected? Access to internet is still a problem for a lot of people. And thinking about who's trying to solve that problem and seeing how that evolves.
Mm-hmm. No, that's great. So, well, since we're on the topic of founders, like I feel that the discussion is going a bit a bit more micro. How about each of you share with the audience, because there are a lot of founders here, and between the five, between me included, we probably see over thousands of startup companies. So, what do you think is sort of the most important factors that enables the company to essentially succeed, and what characteristics do you look for in that in the founder, and that really impress you, that gives you that kind of the take it up? So Erik, you want to start?
Yeah, I'll talk to that. So since we invest in early stage companies, we're very founder driven, right? We don't have a lot of data to go on in terms of traction and so on. So it's you're looking at the product, you're looking at founders, the market opportunity and so on. But ultimately, I think we do lean and have a bias towards looking at the founders and the characteristics of the founders. And things such as having conviction, having grit, and being able to go through tough times. Really important is coachability and an ability to learn, having a learning mindset, right? Not that you find some issues or figure out that your business isn't working, you continue hitting the wall, right? You got to figure out how to go around the wall. Also, in terms of that learning ability and openness to adjust is also, are you willing to take feedback from your investors, right? And coaches and mentees as well. And how do you adapt to that? Also, as founders, for you to take that feedback, you may get 10 different opinions. It's for you to situationalize that, right? And synthesize and then make the right decision. I think the other thing, and I think all those characteristics came to the fore in terms of looking at good founders during the pandemic, right? And they became even more important. I think one other criteria that became really important is, are you able to make tough decisions? And I think, for instance, this was probably the first time that a lot of first-time founders have had to lay employees off. And that's a really difficult decision, a really difficult time. And that's a decision that ultimately lies with you as a founder. And I've seen a lot of founders this past year make those tough decisions very quickly, right, to adjust. But I think ultimately, at times, that was the right decision to make, and they're in a better spot now, and they're able to hire those employees back at this point. So I think being able to make quick decisions, adapting, and conviction and a learning mindset is really important from my perspective.
Mm-hmm. And Rashmi, like in terms of because I know you talked about impact, and feel free to jump in. Like in terms of like the bigger areas such as diversity, gender equality, and social impact. Is there something that you look in the company that is that deciding nudge towards one direction or not?
Yeah, so we, in terms of promoting diversity, a quarter of our fund is dedicated to Black founders. And then at the seed stage, we committed early on that we were going to invest only in women or minority founders in an effort to address the racial and gender funding gap that startups face. But more importantly, I think we're also looking at founders who have some sense of a mission, a broader mission than just building a successful business. Oftentimes, these founders are doing that because of a personal experience or because that they've realized is a common problem. And so, that can also affect groups of people who were excluded or are underserved that we're looking for. In terms of also with, we're investing in companies throughout the US, we're trying to get out of the sort of trap of just investing in companies in California or New York, near New York City, and really trying to look all over the country because there's so many markets in the country. There's great founders and there's just not a lot of capital flowing to them. So we see that as another opportunity as well. And we're looking for founders who, from the start are thinking about the mission and integrate it fully into their business. So unlike other impact funds, which often have their methodology really thought out and have their metrics, pre-planned, we're investing in a variety of sectors and a variety of stages. We're really thinking more about how committed is this founder to a mission. If it's a fintech and they're targeting the underbanked, how committed are they to making sure that in the end, they're not going to sell out and charge lower income consumers more fees because that's what some of their investors want. We want to make sure they always have that mission in mind.
Mm-hmm. Yeah, and then actually speaking of global, I thought that was very appropriate for our topic today, because we all seen that despite the certain separation and isolation of the physical borders caused by COVID, the pandemic actually served as a catalyst to a much more interconnected world. And today's event is living proof. So what does global market, global projects play in your respective investment theme?
Go. So for us, we believe that there's a huge opportunity, especially because of fintech, not just investing in your typical Silicon Valley founder. I think, Rashmi, you said exactly it. There's so much capital that goes to the Valley. There's so much capital that goes to New York. But for us, we looked at it as how do we find amazing opportunities in areas that aren't just, very arm's reach. Traditionally, venture is local, it's arm reach, it's who you can touch, and that's it. So for us at Mendoza Ventures, our mission is to invest in these founders regardless of where they are. So we're currently, our early stage portfolio is invested across 3 countries and across 4 states in the US. The goal of it is finding amazing founders that, where where we're seeing not just amazing talent, amazing opportunities, but at the same time have market share in another market that then can come to the US, can come to Europe, can come to the UK, can come to LATAM. And I think that's an exciting part of where we are, that with sort of this now Zoom world, that you can reach out to co-investors that may not just be down the street that you want to have a coffee to, founders that are not just, you know, in the local accelerator. So we get pipeline of companies as close to Boston to as far as Hong Kong, as far as Europe. And, you know, even for us, our makeup of limited partners are people that are local, but also, you know, an investor in Norway, an investor in out of Ireland, out of Australia, to be able to tap into the network of amazing talent that's out there to find these opportunities. I mean, and so for us, it's, you know, it's one of the strategies that we had done post-pandemic was to find local co-investors in these geographies so that we didn't have to hop on a plane to Toronto or to the Valley or to London, but find co-investors that were there, that we trusted, that knew our methodology, worked with us really well. And that worked for us because in the pandemic, when we couldn't hop on a plane and borders were closed, that we had local co-investors that were actually looking after our companies and these founders. And so that's, I think, the amazing piece of having set up a strategy to work internationally that then during the pandemic really, you know, paid off in spades for us. So I think there's a huge opportunity, as Rashmi said, to find amazing founders. And also for us, 75% of our portfolio is led by a CEO that's either an immigrant, minority, or female. And it is a lot more work to find these opportunities. But at the same time, by looking at founders that we know that have performance, that can produce results, there's a huge missed opportunity for these types of underrepresented founders to find capital. And so that's one of the things that, though we focus on, you know, high return sectors, we're also looking at these founders that are underrepresented, but we know are performing.
Anyone else have anything to add in terms of, you know, going global?
Yeah, I like to join in actually for the global aspect. Most of our founders, one of the aspects that we tend to look at is the ability for our founders to look at their strategy for a global marketplace. And here's the key reason why. When we look at our portfolio, we realized about 2 years ago, you know, our portfolio didn't have enough women. So we spend more time concentrating on women founders. That's both women founders here in the US as well as in Europe and Africa and those places. So we spend a lot of time with trying to look at incubators and accelerators that really have a good mix of women founders, but also women founders that have the businesses that are able to scale globally. And when we say businesses that are able to scale globally, those businesses tend to be like SaaS types of businesses where they can actually sell their products to corporations in Europe and Africa, as well as here in the US. So when we look at global was always a part of what we do as a firm, because we feel that was an opportunity for those companies to really diversify their cash flows and to diversify their revenues. But most importantly, it gives them a chance to increase their valuation. At the same time, it gives them a chance to partner with particular firms overseas so they could segment those marketplaces. So globalization for us was very key in terms of what we do as a criteria. But most importantly, we wanted to make sure that we were really hitting the social impact. We know that a lot of people are looking at ESG investing, but they really weren't paying too much attention to the social impact side. So we spend a lot of time with making sure that S is really being captured in the types of founders that we have in the portfolio.
I'll just jump in here. I mean, Citi is a global bank. Our impact fund, is right now focused on the US, and we're all hopeful that one day we'll go global. In the meantime, you know, our corporate venture, our Citi Ventures, is one of the teams that's working on this fund, and they are investing globally. And you know, we have colleagues all around the world who we hope that we could tap into instead of like the local investor networks that others might be using. So, but right now we're focused on the U.S. and we're all stuck at home, so I don't know that we'll be doing anything anytime
Here's yeah, just to jump in, I just pull it back to the U.S. side for a second, because I think the trends there are similar, right? So when we as investors used to look at, I'm in Boston, right? And like Adrian said, we tend to be very myopic in terms of looking at companies within our region, within arm's reach, aside from funds like Melissa's. I think that's all changing too, right? We are starting to look at companies outside of Boston's a major center, but at the same time, very small, right? You tend to see the same companies over and over again in certain sectors. So I think it's valuable from the investor perspective to look outside at other locations, and whether it's Nashville or Austin or Cleveland, Pittsburgh, et cetera. There's some amazing companies in those locations, and I think that's valuable long term in terms of diversification, and then being able to allocate capital to other locations within the U.S. as well. On the flip side, I think we as investors don't expect companies to have their employees in our locations anymore either. So you're starting to see this migration from Silicon Valley to these other locations, such as Austin, Nashville, and so on. So you're starting to see a lot more diversification in terms of that remote workforce. So I think longer term helps these other regions to grow, and at the same time offers more flexibility to access talent for those companies.
I just want to add to Erik. I also think it helps the investors too. I mean, one of the biggest secret that I learned in global investing, and I'll give you a prime example, Vancouver was a key spot for us for a lot of our firms in the pipeline. And Vancouver was really, really good in terms of kind of getting that flow that was going from Silicon Valley all the way to Seattle to Vancouver. So we saw a lot of SaaS types of companies coming out of Vancouver, but the key notion for us was Toronto. Toronto was a nice secret for us because at that time we were not doing as much in the Toronto area, but we were turned off from that from one of the fund managers down in Australia. So if we didn't have an open mind to work with fund managers in Australia, New Zealand, Malaysia, we would never had that opportunity in Toronto. So it helps us as an investor if we were to do a syndicate where we can look in our pipeline to work with these investors around the globe that have similar investment strategies to come together and to invest in those firms. I think it makes it a lot easier to have those conversations. It's something that I've been doing for quite some time. And if I didn't have those conversations or those relationships, I would never have the opportunity to look in those geographical locations. So I think it helps investors also in terms of what our criteria are, because it gives us another set of eyes to share that portfolio with other investors in other locations. And then again, we share information as to what they see here in the US, but we also ascertain information in terms of what they see out in those particular locations around the globe.
Mm-hmm. Exactly, Ken. And that's why I think that's actually one of the key reason why we help we partner with Wholesale Investor to host this conference is we think that not only the founders needs to reach their the investors, but also even among investors a different region, in different industries have a lot to share and collaborate. So I can't believe the time is almost up now. So we how about for each of us, maybe if you can give the founders out there that's participating in this event and that's listening, give a couple words of encouragement, what you think they ought to do. So a word of advice from each of you, maybe. And again, starting from Erik, maybe.
Yeah, I would say just pulling it back in general, I think that this last year has been a tremendous, like Melissa said, tremendous acceleration of a lot of trends, right? And I think founders can take advantage of that. I think there's a lot of positive, a lot of good things coming at us in 2021, a lot of opportunities to innovate, to take advantage of the situation, to build new businesses, new companies, et cetera. I think as we go back to normal, the opportunities will increase even more, right? And I think it's been somewhat restrained last year. I think, yes, the capital has been out there, but I think there are going to be tremendous opportunities in a lot of sectors, and also those sectors which have been depressed last year, right? I think travel, hospitality, sports, etc. That'll all come back towards the end of this year, and I think it'll come back with a bang. I think people are, for instance, aching to go back to travel, right? They're aching to go back onto the road, and so on. So I think those sectors are really interesting today as well for innovation and investments.
Oh yeah, tell me about it. Yeah, definitely. We have the travel bucket list already. Can't wait. So how about Melissa?
Yeah, I think probably of everything I've learned through the years, and it just holds true today, is, don't get too drunk on the venture Kool-Aid, right? It's what you need to do is figure out who you are, what kind of company you want to build, who you want to serve, and then think dynamically about what the right capital is to fuel you on that journey. There's no good or bad capital. There's just capital used in the wrong way. And I think right now we're starting to break free from that myopic obsession with that homogenous venture narrative. And we're seeing an incredible disruption in the capital markets with all kinds of capital, good and bad, flooding the market right now, equity and otherwise. And I think it's a really important time to see that the value of the templates that we've created, I think we've reached max utility. And now we're like, there's this risk that all founders just try to force themselves into this cookie cutter where we say, this is what investors want. So do this template, follow this path, fit into this box. And I think that there's some utility in recognizing that there are templatized things that can really add a lot of value to you as you're building your business, but recognize that those templates weren't made for you, and they're never going to serve you the way that they really never served anyone particularly well, but they're not made for you. And so really develop a discerning sensibility around that, and find mentors that that can help you customize that narrative for you and for your journey. And while venture as a category now, I think, has diversified in really exciting ways, and just know that that there's so many ways to choose your own adventure, and there's many ways to build the business you want to build. And the biggest risk right now is that we bequeath unto a new generation of entrepreneurs patterns and mores and mythologies that really won't serve them. So I think it's an incredible time to start thinking about rewriting the future. And so don't be too held back by all the things that we say and all the bloviating that all the investors do about pattern matching and what they look for. And look for your people. Look for the people who resonate with you and around you and for you, and leave the other stuff behind.
That's awesome. Yeah, no, that's great. Keep being you. So Rashmi?
Yeah, I mean, I'd really echo a lot of what Melissa said. I've been focusing a lot more on women and minority founders. And so, venture capital is just usually inaccessible, honestly, because it's been such a clubby sort of area. I think that's changed a little bit this last year. I think there are a lot more funds that are rethinking how they're sourcing founders and making commitments. And we'll have to see if that lasts, if that changes any behavior or not. But in the meantime, I think there are other forms of financing and other people who are, like Melissa, who are thinking about other ways that might fit someone's business model a bit better. So, it is more accessible, I think, now than maybe it's been in the past few years, and that's a plus. At the same time, I think, Melissa, you'd made the point that last year, the funding to women dropped. So it still remains to be seen. But I think there's, definitely an effort. I know that also it's coming from, asset managers. So I know, like Yale University, they were saying when they're looking at fund managers, they're looking to make sure they have more diverse teams. So I think it's being driven now by investors themselves and, asset owners, that you're going to start to see a different change. And just demographically in the US, I mean, we're going to be a majority minority country. This is really starting to matter, especially with younger generations. They really are thoughtful about where their money is being held and what it's being used for. So I think this is the beginning of a trend that's going to continue.
Mm-hmm. And the fact that, on the panel we have equal representation here. I was looking. So Ken?
Yeah, I agree with Rashmi 100%. I think the key is to be open to different types of financing. Keep your mind open to not just the traditional venture financing. We definitely see some moves towards the digital asset space. I would not be surprised if the venture financing community becomes more digital. So where people start to use security token offerings as a way to raise capital. So I would hope that people keep an open mind. That's happening already, at least with the advent of blockchain and the advent of cryptocurrencies and crypto assets and so forth. So I would say to the founders, don't get too hard on the matrix. Focus back on the basics of why you have established your business. Get back to looking at managing your cash flow statement. I think that's very critical, because if you're able to manage your cash flow, then you're able to make some critical decisions around how you invest, how you manage operations, how you manage finance. So get back to the fundamentals as to why you do business. Also, in terms of mentorship, that's very important. Get involved into the right incubators and accelerators that actually is going to help you to develop a nice story. Your line for business is not finished yet. So you still have a long way to write a book. So don't feel down. And if you get an opportunity, look on the story behind Nikola Tesla. I think Nikola Tesla was very key in terms of how to look at innovation, but also look at innovation with a purpose.
Absolutely. So last but not least, Adrian.
Thanks, guys. Having been a founder before, and I'm probably one of the few founders that's on this panel that's now in VC, I've lived through multiple dot-com booms, everything from having started my first business in 1999 to, two venture-backed startups starting in 2009. So I've seen different cycles of funding, different cycles of the market go up and down. And I think, having had that experience where I raised capital for the first time in 2009, right after the mortgage crisis, where there was very, very difficult to raise capital. We are at an amazing time right now where, one, there is a lot of sources of capital. Two, the market has changed socially. The number of Black and brown and female funds in venture that have come to the market in just the last 6 months to a year is breathtaking, because venture has been traditionally white, and there's now new venture firms where minority founders like myself, when I first raised money, being Latino, there were no VCs like myself, and now there are. And I think that's an exciting time to be able to see faces that look similar like you, now being there on the capital allocator side, now being there on the VC side. And also the model has changed. 3 years ago to 5 years ago, we didn't have an ability to do crowdfunding. Last month, Backstage Capital raised money on Republic on a crowdfunding platform. So I think the old school models of the expectations of venture. And as a founder, you now have more avenues, whether it's crowdfunding, a whole new generation of venture funds that are Black and brown, female-led, that are looking to deploy to diverse founders, where that wasn't there, 3 years ago, where there was only a handful of us, diverse fund managers that were in the market. I think it's time as a founder to be able to find the right fit of capital for you. That, not only, we like to say capital it's easy to find, it's whether it's helpful. And I think that's something across this panel that's come out, is to make sure that when you're getting that capital, there's a lot of value add to help you. Because again, I think Melissa said there was a lot of capital sloshing around looking for a home. And I think we will see in the next 2 to 3 years what that means for the market. I'm an optimist, and I believe that that's going to create a whole new amazing market here in the UCRES and abroad, of a new generation of entrepreneurs, because having been through multiple recessions, the best companies are built during a recession. When you can rub two sticks together and build an amazing company. And even, rolling the clock a year ago when I was in the Valley in January of 2020, even the investors there were starting to talk about, well, we got burnt by the WeWork situation. How do we start looking at businesses that actually have positive cash flow that are now being, that not just have revenue, but are profitable. And so I think the market is starting to change, and I'm hopeful that, with more conversations like this, and, a fantastic representation of people on these panels, that more founders are open to building businesses that might not come from traditional sources.
Oh, that's a great conclusion, Adrian. And myself included, with a minority founder. So I think it's been an absolute honor to have everybody. It's a great discussion. I hope let's not stop the discussion here. Let's continue to get connected, and collaborate with each other. And again, I thank everybody for your time. And I sincerely hope the light is at the end of the tunnel now. So I sincerely hope we'll see each other again soon. And perhaps, in your city or in my city physically, we'll continue that great tradition.